Welcome on board Gautam Trivedi and chat about what he's making of the market right now. Gautam, hi, good morning. Good to have you on the show. So far, so good. The market has been ignoring just about any negative news and taking the positives in its stride. At life highs now, what's next in store for us?
I think we've had a great run so far this year to date. As far as Asia is concerned, we're the second best performing market after Taiwan. We're up 10.4%. We've also received the most of the FI net. So net inflows now are $5.8 billion, which is huge. And of course, if you look at the rollovers of the Nifty from April into May, we were as high as 76% versus 64% in the month earlier. On top of that, you got implied walls at near several month lows at around 16. And more importantly, FIs have made a big comeback. So FIs are actually back in the market. Even year to date, domestic institutions are actually a negative 1.3 billion in terms of investments. So I think on that front, all of that looks good. But there are certain caveats which we believe could be potential causes of correction. So first and foremost, if you look at the Nifty 50 and the correlation that it's had for the longest time, and more so since the start of COVID with the S&P 500, we believe that if you look at from March 15th of this year, that correlation is starting to actually weaken. And the reason primarily is the fact that the United States is way ahead of not just India, but the rest of the world in terms of vaccinations, and hence, as a result, opening up their economy. We are still way behind on that, and I think we're several months away from reaching a moment where people will be more comfortable stepping out and actually getting back to business as normal. So that's cause number one of worry. The second cause, of course, is the sharp rally in penny stocks. And usually when that starts to happen, one does get that is a signal that the market is toppish. So if you look at the Nifty small cap index, for example, it's up 135% in the last 12 months, double that of the Nifty 50, and of course significantly outperforming the Nifty mid cap as well. So these are some of the issues that are I think starting to scare us. And the retail investors now retail participation, should I say, in the daily traded volume is as high as 45%. But having said all of the above, we don't think the correction is going to be necessarily very sharp. And the reason for that is FII money, which is waiting on the sidelines to significantly come back into the market. It's waiting for basically two factors. First is plateauing of the COVID cases, and second, of course, is the pace of vaccination. So if the second one picks up dramatically, which I hope the government is obviously now completely focused on, if that picks up, you'll see an avalanche of money returning to the market. So like I said, I think there should be a correction, but it won't be very sharp.
Sure. So, Gautam, given that, we've had 1 year of the pandemic already behind us, and the markets have reacted the way they have, climbed the wall of worry each and every given time, where do you think the opportunity is to invest afresh are? Because most of it seems like a well-discovered story.
It's a good point. It's a good question that we get asked all the time, that what is it that you're possibly looking at now putting incrementally money into? So we see a few things that are clearly standing out. As I mentioned, that the U.S. economy's come back, roaring back, frankly. If you look at the numbers for Walmart, Home Depot, Target, for example, 23% same-store sales growth. Apparels within that up 60% year on year. So, you've seen U.S. consumer come back in a big way. And I think there are a lot of interesting mid-cap companies that cater to that demand out of India. So I would certainly look at those. Second would be cement, and I think that's a great way to play real estate, though I think some of the listed real estate companies too are interesting, but I'll get to that in a minute. If you look at some of the numbers that have come out in terms of earnings from cement companies, they've been absolutely staggering. I mean, Ultratech Cement, 93% capacity utilization, and EBITDA per ton up to around 1352. So significant, I think, leverage there coming out of the economy for Ultratech Cement. Similarly, Ambuja, sales up 30%, EBITDA up 62%, and so on. The point I'm trying to make is that I think with the government's push on infra, and which has to sustain to get us out of the problem that we're in right now in terms of the economy. If you look at the numbers for Larsen & Toubro, a little worrying from the way I see it. So if you look at their overall revenue book, 79% of their revenues come from India, the balance are from overseas. Of that 79%, 84% is from central and state government projects. I.e., what does that tell you? That the private sector is not picking up in terms of incremental capex, and as a result, the onus unfortunately falls on the shoulders of the government to do incremental capex, which it has promised to do in the annual budget. The FM did mention a figure of 5.5 lakh crores, which they will do in FY22. So if that starts to play out, I think cement will continue to do well, and not to mention the fact that real estate also has made a good comeback. So I would look at real estate. The other element which we found over the last 3 years, and I've said this before on your channel as well, is the fact that global private equity funds are coming and buying out the management shareholding in listed mid-cap companies. So you've seen a ton of deals happen in the last 2.5 to 3 years. Blackstone buying out SL Propac, Advent buying out DFM Foods, Sequent Scientific promoter stake being bought out by Carlyle, JB Chemicals with KKR coming in and buying out the promoters. So I think you'll see incrementally a lot of that happening. Why that's happening is a separate reason, and I think we can debate that separately, where I personally believe that a lot of the younger generation don't want to live in India. It's difficult doing business. It's not as easy. It's improved significantly over the last 5 years, but it's still difficult to do business. A lot of them want to start restaurants, want to do other things in their life. So they choose to sell off these companies, their family-owned companies, to private equity funds. And the moment that happens, we've noticed that it's instant re-rating for the stock. So we've seen a lot of these companies gone up anywhere from 100% to 300% after the PE funds have come in. So I think that theme will continue, and there are a lot of opportunities even today in the market which are ripe for re-rating as a result.
Gautam, when we're talking about the recovery, is it expected to be more broad-based this time or K-shaped like we had earlier talked about last year? Because, while on one hand, let's put aside stock prices and the new highs, but when you're talking about earnings from cement companies, for example, being absolutely staggering, but is that the kind of opportunity you foresee across the board from some of the other pockets as well? We've already seen a spate of pharma numbers out, even the financials. Overall commentary does seem to be encouraging, but what's your thought?
I don't think that's going to be the case, unfortunately, because I think after the second wave, people have gotten very, very concerned about actually stepping out the way they did after the first wave, hoping that the most of the problem with COVID was behind them. So I suspect that this time around, people will be more cautious about either getting on a plane, booking a hotel, booking a holiday for that matter, within India or overseas. Overseas, of course, is a problem today, given that most countries have locked the door on Indians coming in because of the fear of the Indian variant. But that apart, I think it will not be an overall recovery for all sectors. Some of the sectors that I mentioned will do well, but I think it'll be a gradual recovery given the experiences people have had in India. And it's been very unfortunate, some of the stories that I've personally heard as well. So yeah, that's my personal view.
Okay, so where do you see the maximum impact on the reopening trade? So that would be, of course, naturally things like travel, hospitality. What about discretionary? Auto numbers for May have actually been somewhat encouraging, but do you see a hit coming in there over the next few months?
No, I think if you look at the auto numbers, you bring a good point specific to the auto sector. Months of February and March were actually outstanding, averaging about 3 lakh vehicles per month. I think the demand for auto is still very strong. It's just that we've seen during the lockdown, production's been hit. RTOs in a lot of the states were actually shut, so you couldn't even register the cars even if you bought them. So I think auto would be a beneficiary of the reopening, and that's one trade that's not played out. If you look at tourism, Indian hotels is doing extremely well. So a lot of the negativity around tourism is already starting to get factored in to Indian hotels. And I bring that up because that's the largest hotel play in India. So as a result, I think some of those trades have started to already play out on the reopening. Autos hasn't fully factored that in, and I would certainly look at autos.
Gautam, hi there. Good morning. Wanted to understand your take then as to how you're looking at the overall digitization theme, new tech as well as AI, robotics, etc. Because there do seem to be companies that are venturing into this space in the listed universe as well as otherwise. Is this something that you think is the need of the hour, especially in the pandemic times that we're currently in?
That's a very good question, and I've been asked this in the past as well. So the problem is, in India we don't have too many listed plays, and in a very limited non-IT and non-software plays in India. So if you look at the pecking order, you've got InfoEdge with about 68,000 crores in terms of market cap. You got IndiaMart, India Intermesh, 26,000 crores, and then you've got everything which is sub 5 or 6,000 crores. So very limited choice in absolute number as well as in terms of market cap for a institutional investor to actually get in and put serious money to work. So as a result, a lot of Indians themselves are actually doing LRSs and investing in companies in the US on NASDAQ, on the NYSE. So I don't think you've seen that yet, but if you still want to play AI, you still want to play some of those factors, I still think the best way to do it is to play the listed IT companies because they're getting increasingly active in those verticals. And in the absence of any listed play today for the average investor, I think playing Indian IT would be the best way to do it.
My line has cut.
I can hear you if that's...
Right. Okay. Talk about IT and we get some tech troubles there. Gautam, just wanted to understand, and we've been asking most of our experts as well on the show this. If a client had to come to you today at these market levels and just ask you straight up, how is it that I get rich in the next 1 year? What is your piece of advice to him?
I would say that 1 year needs to be stretched to 2 or even 3 for that matter, because the market at this point is factoring in a lot, not just specific to tourism, not just specific to maybe a cement or industrials. The market today has factored in a lot. So I think until we don't see, and of course the wild card still remains COVID vaccination, which in turn will impact the lockdown, which in turn will impact GDP growth and so forth. So I think that's something which I would not expect people necessarily to be that bullish, or the big money that's been made in the last 12 months may not necessarily be repeated. I'm talking from a market overall standpoint over the next 12 months. We've seen an 80% move in the year 2020 in the Nifty 50. I don't see that happening until we get clarity on the vaccinations. So I think that is the biggest stumbling block. The second issue that I see in the market today is the macro risk with respect to the government's finances. And I think as much as the Prime Minister is right behind privatization, right behind asset monetization, we really haven't seen any significant move thereafter after the announcement made by the Prime Minister. So he's firmly behind it. But again, it's odd that we don't see enough being done in terms of actual asset sales or actual strategic investors coming in, even when we have the market at a lifetime high, as we just discussed. So that pace has to pick up. I think that after COVID remains the single biggest risk to the market, that the government's not moving fast enough in privatizing and asset monetization.
Sure. The other thing, Gautam, which you also briefly highlighted towards was the fact that input cost pressure is something that's going to escalate. We all know what's happening with commodity prices and across the segment. I'm not just talking metals here, but even agri-commodities. That coupled with crude, which is already back at 72 a barrel, that's going to definitely weigh heavy on India Inc.'s report card next quarter.
I fully endorse that. In fact, I think some of that impact's already starting to come in the auto numbers. If you looked at Maruti's numbers for the fourth quarter, the impact of rising raw material prices was very evident. And I think that will continue at least for the next couple of quarters until we don't see a base effect kick in. So I don't think that's going away anytime soon. Again, I'm no expert on commodities, but even if commodities don't necessarily go up as fast as they've done in the last 6 to 8 months, even if they remain at these elevated prices, that's clearly not good news for a lot of the companies that consume these raw materials. And their ability to then pass on in this current economic environment in terms of price increases to the end consumer is going to be very difficult. So yes, some of those companies will have challenges.
Gautam, if I were to kind of step back for a minute, how much further from here? We're trading at, these new highs. We're watching out for a reopening on the back of which everyone is extremely optimistic. So what is a realistic assumption then, let's say even for a year-end target?
We don't do year-end targets, and I'm kind of scared to actually throw up a number. But the longer-term outlook for this country is absolutely phenomenal, and that hasn't changed. That basic intrinsic story hasn't changed. And I think the one thing we keep looking at are the FII numbers, which in some sense are not doing full justice to the amount of foreign interest that lies within India. So if you look at last year, calendar 2020, you had $23.5 billion of FPI money that actually came in. But if you look at the VC and private equity money, that was $47.5 billion. If you look at FDI, $64.7 billion. So if you collate all of these three numbers, you had a whopping $135 billion that came into India last year from foreigners. So the allure of India, the growth prospects, this unfortunately has been a huge air pocket that we've got stuck in, caused by external factors. Government's not to blame for it. But I think going forward, if we can roll up our sleeves, i.e. the government does that, increase the pace of vaccinations, I think by the third quarter of this year, earnings will come back with a bang. That's my personal belief.
Okay, great. And in terms of, the current factors at play in the global environment, the overarching fears around inflation and what that may imply for rates going forward, even if we're taking a look at next year, what do you feel is the resulting impact on flows going ahead? Because while, of course, the India story remains intact, would it still be the preferred destination among some of its emerging market peers going forward, just based on, on some of the domestic factors that we've seen so far?
Well, I think, yes, inflation has been a concern. And of course, the Fed has so far left rates unchanged. We've seen some volatility in the 10-year US bond, but then again, that's diminished in the last few weeks. But having said that, I think it's the sheer amount of capital and money that's sitting, not just in the United States, but globally. Of course, the US, I think, ends up being having a disproportionate share of the FPI money, FPI, FDI, VC, etc. That money coming into India. I don't know what the number is. Maybe it's 60%, maybe it's 2/3, whether it's coming directly from the United States or via funds based out of Asia or Europe. So I think if you focus on the US market itself, today, US consumers, US citizens are sitting with more than $2 trillion in their bank accounts. And that's a number quoted by Jamie Dimon of JP Morgan. That money will find its way into emerging markets. And I mean, some of it, again, I'm referring to a fraction of that. But let's get real. What did it take last year to move the Indian equity markets? $23.5 billion of FPI money, and of course, retail participation, because we had 8 months of continuous redemptions with domestic mutual funds. So clearly, they were not net buyers. The net buying actually was coming in from foreign institutional investors, and all it took was $23.5 billion. So it doesn't take much to move the Indian equity markets.
Gautam, what is it that you're tracking within, some of the stocks that have recently made their listings or those that are likely to make their debuts? We've had quite a hectic year as well in terms of the primary markets. Have there been any specific companies that you would track or any business models that you find attractive?
I think to your point earlier, the question rather earlier with respect to tech companies in India, I am really looking forward to the big jumbo IPOs for Zomato, Paytm, Delhivery, because it's time we got more of these tech companies listed in India versus having Indians going overseas to buy and play the tech sector. And I think this is going to be a very exciting 12 months with some big companies. Nykaa, I forgot to mention as well. At least 4 big companies, great valuations. The question really is, and again, a word of caution here, is will the listed space give the same valuations that VCs and Ps are giving these companies? So that's something which will have to be watched and understood. But I think the next 12 months are going to be very exciting. You'll see 4 big Indian homegrown tech companies getting finally listed.
Okay, fair enough. So there are bang IPOs as well that the street will closely be eyeing. What about the overall environment when it comes to commercial real estate and looking?
I think if I heard the question right, your question was about commercial real estate. We're not as positive on commercial real estate as we are on residential. And I wanted to share some numbers and some factoids which I came by on real estate. First and foremost, the participation or the contribution of listed real estate, Indian listed real estate companies has gone from a mere 5% 5 years ago to now about 16%. So you're seeing RERA starting to kick in, where a lot of the smaller players actually get weeded out. Secondly, today, the Mumbai metropolitan region and Pune account for 46% of all India's sales for real estate. So I think the focus should be on some of the Mumbai-based developers, Oberoi. Of course, Godrej is an all-India player, but they've got a huge percentage of their revenues coming from the MMR region. So these are some of the plays that I would focus on for real estate, not so much on commercial real estate.
All right. All right, Gautam, we'll let you go on that note. Thank you so much for joining us and sharing with us in detail your outlook on some of those key sectors and also earnings and how things are expected to evolve going forward.